Mr. AG here. Silver just broke below $86 per ounce, down 2.66% on the day. And I need you to sit with something uncomfortable for a minute before we go any further, because this is the single most important observation in the precious metals market right now. The US and Israel are conducting the most intense military strikes of their entire campaign against Iran. Day 12 of active combat operations. The Pentagon is pledging to continue until the Islamic Republic is defeated. The Strait of Hormuz, the choke point through which roughly 20% of global oil passes, is effectively shut down. Oil prices are spiking. Inflation fears are back. Global supply chains are fracturing. This is arguably the biggest and most potentially destabilizing geopolitical event in decades. And silver fell. It did not rally. It did not surge on safe haven demand. It did not spike on supply chain fears, given that silver is a critical industrial and monetary metal. It fell 2.66%. That fact alone is worth more than every technical indicator on every chart you will ever look at. Because what a market does in the presence of its most bullish possible catalyst tells you something that no moving average ever will. Drop Mr. AG in the comments right now. And I want to know where you're watching from tonight. Are you in the US? Are you in the UK? Are you watching from India, from the Gulf region, from somewhere in Asia, from Australia, from Europe? And I have a specific question for you tonight beyond your location. Do you think the fact that silver cannot rally during an active war in the Middle East, with the Strait of Hormuz shut down, is bearish, or is it actually the most bullish setup imaginable? Think about that. Drop your answer in the comments. I will tell you what I think both sides look like in a moment. First, let me be clear about who I am and what this channel is, because we are getting a lot of new viewers right now given the geopolitical situation. I do not sell signals. I do not sell courses. I do not run paid memberships. I do not sell anything. If anyone reaches out to you claiming to be me or representing Mr. AG and tries to sell you any kind of paid service, block them immediately. That is a scam. I'm only on YouTube and X. My handle on both is Mr. AG Asian Guy. That is the only way you know it is really me. What I do here is lay out the raw data, the full context, both sides of every argument, and let you make your own decisions. I'm not going to tell you silver is going to the moon, and I am not going to tell you it is going to zero. I respect your intelligence enough to give you the complete picture and trust you to evaluate it yourself. Now let me walk you through what is actually happening, because there are multiple forces colliding right now, and understanding each one individually is the only way to see the full picture. The Iran situation. The US-Israeli campaign entered its 12th day with the Pentagon reporting its most intense strikes of the entire conflict. This is not a limited engagement. This is a sustained military operation with the stated objective of defeating the Islamic Republic's military capabilities. The Strait of Hormuz is effectively shut. Shipping is disrupted. Insurance underwriters have pulled coverage. Oil is spiking. And President Trump has made comments suggesting the conflict could end sooner than expected, which introduces a wild card of potential de-escalation that markets are trying to price simultaneously alongside the escalation. So you have the most intense military strikes happening at the same time as the president suggesting it could wrap up soon. The market is caught between those two signals and does not know which one to price. Now here is the inflation angle. US inflation held steady at 2.4% in February before the Iran war even began. That was the baseline. Now you have oil spiking because the Strait of Hormuz is shut. Energy costs feeding into transportation and manufacturing, food production, everything. The war itself is inflationary. And markets are responding by scaling back expectations for interest rate cuts from the Federal Reserve and other major central banks. The Fed is widely expected to keep rates steady at its meeting next week. Traders are now anticipating only one 25 basis point cut for the entire year, potentially not until September. Think about where we were just months ago when the market was pricing in multiple cuts. That expectation has been systematically dismantled, and the Iran war just accelerated the process. Higher for longer interest rates are a headwind for silver. That is a mathematical reality. Silver pays no yield. When you can earn Bourse Chamran by 4 to 5% in a treasury bond with the backing of the US government, holding a non-yielding metal has an opportunity cost. Institutional portfolio managers are acutely aware of this cost, and it influences allocation decisions at the margin. That is one of the forces pushing silver lower today, despite the geopolitical backdrop that should theoretically be sending it higher. Now let me give you the bear case clearly and completely, because it deserves to be heard and understood on its own terms. This is the most important bear argument in precious metals right now, and I have been thinking about it all day. When a market cannot rally on its most bullish possible fundamental catalyst, that is a warning sign. Full stop. There's no way around this observation. The Iran war is the most bullish possible development for safe haven metals. Active military conflict. Strait of Hormuz shut. Oil spiking. Global instability at levels not seen in decades. If silver cannot rally on this, what exactly will make it rally? That question should keep every silver bull honest, because the answer might be that the market has already priced in a tremendous amount of bullish expectations over the past months. Silver has had extended winning streaks. It has rallied significantly from lower levels. The move may already be in the price. And when everyone who wants to be long is already long, there are no new buyers left to push it higher. That is how exhaustion works. It does not announce itself. It shows up as a market that refuses to respond to bullish news. And that is exactly what we are seeing right now. Additionally, the Fed keeping rates higher for longer removes one of the catalysts that silver bulls were counting on. Rate cuts weaken the dollar and reduce the opportunity cost of holding metals. If cuts are delayed to September or later, or potentially taken off the table entirely, if inflation reaccelerates due to the war, that is a sustained headwind. Oil prices spiking is inflationary, which sounds bullish for hard assets in theory, but in practice. It causes central banks to maintain restrictive policy, which is bearish for all non-yielding assets, including silver and gold. The market is caught in a paradox where the geopolitical event that should be bullish for metals is simultaneously causing the monetary policy conditions that are bearish for metals. That paradox is why silver fell today instead of rallying. If the war continues and inflation expectations rise further, the Fed may not cut at all this year. That removes a major pillar of the bull thesis. U.S. stock indexes have turned wobbly with elevated risk aversion. That sounds bullish for safe havens until you consider the possibility of a broader deleveraging event where correlations go to 1 and everything sells. Stocks, bonds, commodities, precious metals, all of it. People scramble for cash. Margin calls hit. The liquidation is mechanical, not fundamental. We have seen this pattern before. In the initial phase of a crisis, even safe haven assets get sold as investors raise cash. Silver could decline further before safe haven flows kick in if the equity market sell-off intensifies. That is the bear case, and I am not going to pretend it does not have merit. It does. Now the bull case. And I want you to weigh this just as carefully. The longer-term technical postures for both gold and silver remain significantly bullish. Both markets have seen their near-term chart structures improve over the past few weeks. This improvement continues to invite chart-based speculators to the long side. The longer-term trend has not been broken by today's decline. A 2.66% daily move is volatility within a trend, not the end of a trend. The daily noise does not override the monthly structure, and the monthly structure remains bullish. Crude oil prices spiking is a bullish outside market element for gold and silver when viewed through the correct time frame. Yes, higher oil causes central banks to delay rate cuts in the short term. But higher oil also drives inflation expectations higher, weakens consumer purchasing power, increases economic uncertainty, and ultimately forces central banks into a position where they have to choose between fighting inflation and preventing a recession. That choice historically resolves in favor of cutting rates and printing money, because governments and central banks always prioritize avoiding recession over fighting inflation when forced to choose. When that pivot happens, and it always eventually happens, precious metals explode higher. The oil spike may delay the pivot, but it makes the eventual pivot more dramatic. Investor and commercial demand for silver remains solid. Central bank demand for gold remains at historically elevated levels. The structural buying from sovereign institutions has not slowed despite the war. If anything, geopolitical instability reinforces the rationale for central banks to accumulate gold as a reserve asset outside the dollar system. The moves by major economies to stockpile rare earth minerals continue to support both gold and silver, especially silver, given its critical role in electronics, defense, energy, and advanced manufacturing. And here's the bull argument that directly addresses the bear case about exhaustion. The fact that silver is not rallying during an active war does not necessarily mean the bulls are exhausted. It might mean something completely different. It might mean that the paper market is being suppressed while physical demand accelerates in ways that are not reflected in the spot price. We have seen this pattern repeatedly. Paper prices decline or stagnate while physical premiums expand. Dealer inventories tighten and lease rates climb. London lease rates are already at all-time highs. Physical tightness is measurable. If the paper price is being held down while physical demand intensifies during a war that threatens supply chains and shipping routes, the eventual snapback becomes more violent, not less. There is also the Trump wildcard. He suggested the conflict could end sooner than expected. If a ceasefire or diplomatic resolution materializes, the risk premium comes out of oil. Inflation expectations decline, rate cut expectations get repriced more aggressively, and precious metals could rally sharply on the shift in monetary policy outlook, even as the geopolitical premium itself fades. The end of the war could paradoxically be more bullish for silver than the war itself if it triggers a dovish pivot from the Fed. That is a nuance that most analysts are missing right now. Let me ask you something. For those of you watching from India and Asia, where physical demand for silver has been consistently strong, what are you seeing right now? Are people buying more aggressively because of the war? Are premiums rising at your local dealers? Are people treating this dip as a buying opportunity? Drop it in the comments. Because the ground level reality in physical markets often tells a completely different story from what the paper price suggests. About 70% of you watching are not subscribed. If this both sides, data-driven analysis is helping you see through the noise and make better decisions, hit subscribe. That is how we grow this. Not through hype, through substance. Join our WhatsApp community for real-time alerts and discussion. Link in the description. Follow us on X at Mr. AG Asian Guy. That is where I post first when something breaks. 3 key takeaways. Number 1, silver fell 2.66% below $86 despite the most intense military strikes of the Iran campaign, the Strait of Hormuz being effectively shut, and oil prices spiking. When a market cannot rally on its most bullish fundamental catalyst, you have to take that seriously. Either the bulls are exhausted and the market has already priced in the geopolitical premium, or the paper market is being suppressed while physical tightness builds toward an eventual violent repricing. Those are the 2 interpretations. Both are credible. The data over the coming sessions will tell us which one is correct.